Greetings. Welcome to Nova Leap Health Webcast. It is now my pleasure to introduce your host, Chris Dobbin, President and CEO. Thank you. You may begin.
Thanks, Sherry. Welcome, everybody. I'll keep this brief. For those of you who've heard the presentation before, I can run through this pretty quickly, and then I'll take some Q&A at the end. So Nova Leap Health Corp, we're traded on the Venture Exchange, been in existence since the early part of 2016, and we're in what's called the home care services space. And so we've grown fairly quickly over the last few years, and I'll take you through some of the growth and some of the charts we have a little bit further on in the presentation. But just a summary, we are part of one of the fastest growing industries within Canada and the U.S., which is where our focus lies. We've had fairly significant growth on a revenue, operating cash flow, and EBITDA basis over the last couple years, primarily the last two and a half years, driven primarily by a fairly aggressive acquisition plan. And I'll take you through some of the manners in which we make acquisitions in the areas that we've entered into. The first question: what do we do? You know, what is home care or home health care? You often hear the two terms used interchangeably. So we're primarily on the non-medical side, which is referred to as home care. Our focus is on dementia care. We would help with companionship, medication reminders, groceries, doctor visits, mobility issues, bathing, anything of a non-medical nature. But we also do provide some medical assistance as well. Think of a MedPour, for example, as one particular avenue. The states in which we operate vary by licensure, and so it's one of the questions that often comes up. So depending on where we operate, so for example, we would require a license in the state of Rhode Island and New Hampshire, Oklahoma, but not in other states, for example, like in Vermont or Massachusetts or Nova Scotia, where we operate, obviously being the province in Canada. The segment that we're after is primarily the 6 to 7% on the non-medical side. That's a very specific part of the overall home healthcare industry. The largest part is made up of Medicare and Medicaid, and so we're in what's called the private pay side of the business. So if you were to look at our revenue, about 85% of our revenue would be what we call pure private pay, so out of pocket by the seniors we provide service to or their adult children. The other 15% would be a combination of veteran affairs or long-term care insurance. So that's the makeup of our revenue. So we're not impacted by changes to legislation that oftentimes will impact either the Medicare or Medicaid side of things in the U.S. What's driving the opportunity? It's really demographics. When individuals attain the age of 65, there's a high likelihood they have at least one chronic condition, and it's the chronic conditions that are leading to assistance that's necessary in people's homes. We think we're in a good market. We take a look at actually what's happening in COVID, shift gears for a second, and the care that we're providing is really within the home setting. And so you think about that in today's, social distancing, or maybe a better term, the physical distancing that's required. That's really where we're providing care, is within an individual's homes. And even prior to COVID, if you look at the surveys, about 90% of those surveyed would indicate that they want to remain in the home. Their loved ones have grown there. They're more comfortable there. And so I think even in light of what's going on in the global environment today, we're well positioned going forward, given that we're already taking care of people within, call it an isolated setting within their home, where it's a little bit more controlled environment. So, we feel pretty comfortable with where we are as an organization in light of the current global circumstances. And I will say that we are considered an essential service in all the areas where we operate, so in Nova Scotia and all the states, and I'll take you through that in a couple slides. So what's our strategy? We've been making a number of acquisitions since the latter part of 2017. We've gone into Rhode Island, Vermont, New Hampshire, Massachusetts, Oklahoma, most recently a startup location in Ohio. and have made 2 acquisitions in the province of Nova Scotia. And so we have three pillars for growth for us. One's organic growth. We can do that several ways, whether it may be increasing billing rates, if that makes sense, expanding the current geography where an office provides service, or as we enter into different states, opening brand new office locations in different areas. So those are the 3 primary ways that will grow organically. From an acquisition perspective, we've done a number, and that's really what's led our growth. We'll continue to do that. We continue to look at acquisition opportunities. But really what we're looking for is a non-medical, private pay business that's independent, non-franchised. And, usually it's been around for 10 or 15 years. There's an owner that is generally looking for a succession plan, so he or she is looking to retire, and the office staff will remain as part of that transition. I think we've been very fortunate that we've been able to maintain the staff that have been working there prior to our acquisition, and the staff that we have, I think, are just they're exceptional. And if you were to ever test someone's capabilities, what better time to do it than through a pandemic? So I can tell you how comfortable I am with the staff that we have throughout our organization. I think they're exceptional, and I'm certainly glad they're part of our team. The third pillar for us would be joint venture partners. So we have looked at potentially partnering with hospitals as an example, just given the way that they're reimbursed through CMS. So there may be opportunities there, or with technology companies as an example, but I won't spend a lot of time on that at this point. Revenue growth. If you look back, and I got this question a lot early on back in 2016 when I was talking about what our plans were, and why did you go public? Why not stay private? And my belief at the time was that we could bring a dementia focus to the industry, and that there was thousands of these companies that would eventually be in need of a succession plan. And my belief was that if we put these companies together and had great people leading them within their respective geographies, that we could bring big, best practices to bear. We could leverage technology. We could consolidate some back office functions, and that would lead to a stronger organization as a whole, and would also lead to opportunities for growth from people that may be restricted by being in a smaller environment. So I think that's played out thus far. And what we've seen is I think certainly from a percentage perspective, fairly incredible revenue growth. We do report in U.S. dollars, so in the last few years we've gone from $40,000 of revenue in 2016, again when we started the company, to $17 million is what we reported to the tail end of 2019. So fairly significant from a revenue perspective, although we still remain a very small publicly traded company for the moment. I think last year was key for us, and I really think it demonstrates just the scale that we're achieving and the impact that scale has. I think we've been fairly consistent in terms of how we've done our press releases on a quarterly basis, and those that have followed our company and that follow along, I think we'll see very similar information that we present, pretty much every quarter. And one of that, some of that information is obviously on the EBITDA growth, and you'll see last year that we achieved pretty good inflection point last year. We were operating cash flow positive last year, positive EBITDA. And so last year, 2019, was really key for us. And I think we've entered 2020 certainly in the best financial condition we've ever been in, and are in good shape, I think, to either to weather the storm of COVID or to continue with our growth trajectory. So this is probably my favorite part of the presentation. We sort of take a look at what we've done over the last 2.5 years. So we take back when we really started our acquisition strategy, which was in October of 2017 to now. All those dots that are on the map, and this is a map, by the way, it's up in our boardroom in our office. What you'll see there are all the locations where we currently have operations. So Nova Scotia up to sort of the northeastern part. And then you'll see that we're in Vermont, New Hampshire, Massachusetts, and Rhode Island. And then if you look in South Central, we've just made a foray into Oklahoma by way of an acquisition this past October. And so we spent the first couple of years, really, building a platform within New England, and I think that's been very successful for us. And again, if you go back through our quarterly reporting, you'll see that. And really, we got to the point where we saw an opportunity in Oklahoma. It was a business where we could it certainly ticked the box in terms of what we're looking for. Our business has been around for some time, a great office team, other avenues to grow within the state of Oklahoma by other other further acquisitions or new office locations and some adjacent states that are interesting to us. And so, our plan was really to expand South Central, similar to what we've done in New England. And I will say that, we're not done growing in New England. We think there's other opportunities that will come up. And so certainly our plan is to continue to grow within the New England states. So, stay tuned for that in the future, because I think we will continue with our strategy there. So what do we look for? Again, U.S. and Canadian geographic focus, positive EBITDA, historical cash flow, positive, normally 5+ year history. I'd say most of the acquisitions we've done have been between 10 to 15 years of history. And they are small businesses. Again, these have not been large acquisitions by any means. I think if you take a look back at our acquisitions, our revenue has generally gone between about $1 million to 3.2. That's been either sort of a tuck-in on the low end or a couple of larger acquisitions. So, definitely small businesses by any stretch of the imagination. But again, our belief is that if we take these small businesses, we combine them onto a larger platform as part of an existing, larger organization, we start to see some synergies. And one of the ones that we've always reported on a quarterly basis has been head office costs as in comparison to, or as percentage of revenue. And what we've seen is it's gone from, I think, 54% in 2017 to 11% in 2018 to, under 7%, in 2019, and it continues to go down on a quarterly basis. So that's just demonstrating the scale. So again, along with the improvement in operating cash flow and EBITDA, again, last year was a critical year for us. The number of acquisitions we've done over the last couple of years have averaged 4. So in 2018, we did 5. Last year, we did 3. We haven't announced our number for this year, but we continue to look at acquisition opportunities, and we're certainly not done growing by way of acquisition. So I think what you'll continue to see are both acquisitions as well as new organic locations, similar to what we just did in Ohio. We've got a fairly lean management team at head office in Halifax, Nova Scotia. These are on our deck on our website, so I won't spend a lot of time on this. There are 4 directors, 3 of which are independent. I'm the other one. So again, a small board of directors, but one that very knowledgeable about what we're doing and has been very supportive. The company is 38% insider owned. Let's say we insiders have led, I think, all but one of the private placements. The cap table is what you see in front of you there right now, with 65 million shares outstanding. We have just come off convertible debt financing, so we do not have a need for financing. We raised just over $3 million Canadian, which was twice oversubscribed, closed 2 tranches, one in December and one in January of this year. And so we've entered into the year certainly with the strongest cash position I think that we've ever had in the history of our company. The cap table is fairly simple. There are some options that are primarily for the leaders of our businesses, as well as the management team at head office and some members of the board. From a debt perspective, I think I'll touch on this for a moment. If you were to look at our balance sheet, what you'll see, sort of break our debt down probably into 4 categories. One is we do have a revolving operating line of credit. It's $1 million Canadian, which I think we just switched to US dollars given the exchange rate. It has been unutilized for the most part. we got that last April of 2019, the first time that the bank had given us a revolver, given that we'd gone from a pure startup to a company that had demonstrated fairly significant growth. And so that was key to us. We have 5 facilities that relate specifically to 5 separate acquisitions. Those show up as demand loans on the balance sheet. And I think this is where there's some confusion. People see the demand loan and it's shown as a current liability, and people often think that that's the amount that we have to pay back within 12 months, and that's not the case. It does have a demand feature, and so we do show it as current, but it acts very similar to a term loan where you pay principal and interest on a monthly basis, and that's what we do for each of those facilities. And the remaining term in those facilities range between 2 to 5 years. The third category you'd see would be promissory notes, often referred to as seller notes or vendor takebacks. So these are part of the transaction structures that we've done with the sellers. And then the fourth would be the convertible debt that we just raised. So that should give the flavor of the 4 categories of debt that we have. I'm very comfortable with the debt that we have on our books. We'll continue to use debt as a financing tool going forward. I think because we're buying companies on their own that can leverage, it makes sense for us to do that. I will say that from, in terms of how we've purchased the companies, we've typically paid between 3.5 and 5 times EBITDA. I think we've been very consistent in terms of how we've done that. In one case, one of the sellers did take shares out of Treasury, and then all the other deals have been structured with cash on closing, a vendor takeback, or an earn-out structure. So again, fairly consistent in terms of how we've done our transaction, and we're pretty flexible in terms of how we can do them as well. So that should give the sense of the sort of the valuations that we've paid, again, very consistent, but also fairly consistent in terms of how we've structured our deals. Last slide before I flip over to the Q&A, because I know we've got a couple of minutes left, just the comp table. And I use this term loosely because we're showing some fairly large companies here, but Amedisys, LHC Group, and Addus, they're all primarily Medicare, Medicaid, and certified companies in the U.S., so U.S. publicly traded companies. We follow them quite closely, and they're certainly their metrics, and the 2 primarily ones that are used would be a percentage of revenue and or a function, a multiple of EV. So we track them pretty closely. We're obviously trading well under that, but those are very large companies. But it gives you a flavor of how companies within our industry trade, at least based on those dates. So let me flip over to Q&A, and just so we have any questions as we have the last couple minutes. What do we have here? Yeah, so recurring revenues. So we do have recurring revenues. It's a recurring revenue model. I mean, really what we have here is our clients that we're typically sending in a caregiver into a client's home, generally during the same time for the same amount of hours on on the same schedule. And so usually the same caregiver. So, we would have some clients who would have a minimum of 3 hours a week, all the way to 24/7 care. And so, for example, someone that would have 24/7 care, we may have 5 caregivers on a rotating shift. So but it is a recurring revenue model. Again, typically the same clients with the same caregivers for the same schedule. And on average, our clients are usually with us 2.5 years. That's the average. We do have some 24/7 clients that have been with agencies we've acquired for 7 years, and we may also do short-term work where somebody comes from a hospital or an acute care setting. We take care of them for a short period of time at home, and then maybe they have some Medicare coverage after that. One of the questions, aren't U.S. and Canadian healthcare operating in regulatory environments different? Again, we're in a private pay, so what you don't see is a big difference in terms of the agencies and how they operate. What may be different is really the regulatory environment if there is a license required. But again, because we're not after Medicare or Medicaid certified type companies, we're not subject to what would be vastly different rules and regulations within the U.S. as opposed to Canada. So hopefully that gives some clarity there. Now, how do you get efficiencies doing both at the same time? So the efficiencies really come from the fact that we've consolidated back office functions and leveraged technologies. So we have a technology we use that ties into our billing system, which is critical for us, as well as our payroll and accounting functions. We have an accounting team in place that looks after the agencies that we have, and we have common management throughout the system. So we may have a regional director that looks after 2 or 3 agencies depending on the case, and so it allows us for best practices. So those are some of the ways in which we generate efficiencies. And I think if you were to go back to the quarterly results, what you'd see is that those efficiencies have been showing up, whether it be gross margin or from an EBITDA margin perspective. So it looks like those are the only questions. Let me just see. I'll do refreshed just before. Yeah, COVID. So has COVID impacted the business? I mean, sure. I mean, it's impacted the business from the perspective of, looking at PPE. And I want to say that's not a material item for us because we're not on the skilled nursing side. Again, it's mostly non-medical, but certainly there'd be a higher demand for that depending on the state in which we operate. Again, some of the legislation is different, depending on the state or the country. And just really, I would say the other 2 things are just really paying attention to the legislation that's been coming out, as well as guidance from the CDC or Health Canada. And so certainly there's been a much greater focus on those types of issues from the business. But again, we're pretty fortunate that we do run businesses that are considered essential services. But there's been a larger focus on sort of these other issues that are certainly related to that, I guess, is the best way that I can put it. I don't see any other questions coming up here. I think we're over time. Sherry, how are we making out?
We are good.
All right. Thanks very much, everybody. Really appreciate your attendance today. I'm pretty easy to get a hold of. If anyone has any follow-up questions by email, give me a shout anytime. My information's, I think, all over the place in every press release. And the investment presentation can be downloaded from the web at any time. Thanks very much. Appreciate it.
Thank you. This concludes today's webcast. You may disconnect at this time, and thank you for your participation.